Stop whatever you're doing and pay attention to this video because these ETFs are legitimately changing the game and changing how you may want to invest going forward in a massive way. What's going on? Welcome on in here to the TC Trading channel. And if you guys like big, fat, juicy yields, this video is for you. Dividend investing has been something that investors have been doing for quite a long time. You pick some stocks that have nice dividend yields and those dividends that have now proven to grow over the course of that stock's lifespan. And you can buy those stocks and cash in on a quarterly basis. Many times you'll even look over to REITs, real estate investment trusts, and many of those will actually pay monthly. And so you'll get that monthly dividend yield and they'll split that up, and many of them will be up in like the 5, 6, sometimes dare we say up in the double-digit range on an annualized basis in terms of your yield. That'll get split up across the 4 quarters or every month, however frequent they want to give you that dividend. But there's a couple new ETFs out here that are pretty substantial, and I want to talk about them because this could be a big shift in a portfolio, or a way to hedge a portfolio, or a way to get exposure to different stocks that you might be scared about because of the potential downside, with a lot less downside. Let me show you why. Right now on your screen are the YieldMax ETFs. These are ETFs that right now on the top of our screen are showing you some nutty distribution rates. Now, the distribution rate, technically speaking, is the annual yield an investor would receive if the most recently declared distribution, which includes option income, remained the same going forward. This is calculated by multiplying an ETF's distribution per share by 12 and dividing the resulting amount by the ETF's most recent NAV. The distribution rate represents a single distribution from the ETF and does not represent its total return. The 30-day yield underneath that, which we'll cover in a second, is different. This includes net investment income, which excludes option income earned by the ETF over a 30-day period. Here's the dates, expressed as a percentage rate on the ETF share price at the end of the time. All of these ETFs have a expense ratio of 0.99, so about 1%. Let's just call it what it is. How do they do this? Selling and writing calls is how they do this. This could limit your upside, and potentially will limit your upside on these ETFs over the lifespan. And they have a couple disclaimers here that this is not going to be guaranteed forever. But what is going on? What the heck is this? Like, what are these things? And are there other ideas, ETFs out there that maybe are a little bit safer, more diversified? Yes, and we'll cover one of those in a second. There's a lot out there, and there's more coming onto the market, I feel like, every day. But what essentially we have is a way to get exposure to ARK Invest through OARK, Tesla through TSLY, Apple through APLY, NVIDIA through NVDY, and Amazon coming soon through AMZY. What that means is you're going to get exposure to these different stocks, but you're also going to get paid a monthly dividend because YieldMax is going to be selling covered calls, out of the money covered calls every single month against the underlying position in these different companies. And they're going to use that cash flow that they generate to pay the investors. So obviously, if the stocks go crazy, what happens when you sell a covered call? Well, let's look at ARK Invest, for example. Let's say that over the next month, I sell a covered call at the $50 strike price on ARK because I have 100 shares of ARK, and I sell a covered call at $50, which happens to be right here. Let's say that ARK goes to 55. If I sell a covered call at 50, I'm going to be required to sell my shares of ARK. They're going to get taken away from me essentially on the expiration date, as long as I'm still holding this covered call. By the end of this period, they'll get taken out at $50 and the stock goes higher. So technically speaking, if I just have the shares of ARK, didn't sell a covered call, and ARK appreciates to 55, or I'll say let's go to 54. ARK appreciates 20%, give or take. Great, I'm up 20%. In this case, I would be up about 11 to 12% if I got taken out at 50. Then you have to add on how much money I sold the covered call for. That's income. Then that adds into that net return, and then I'm done. So yes, there's downsides here, right? Your upside could be limited. It could be capped in a sense. But the downside protection is that you're getting paid monthly, you're cash flowing, and you're getting the exposure, but you're having a little bit, or you're taking on a little bit less risk because you know every single month, even if ARK goes down, they're going to pay me a dividend. They're going to sell a covered call. If that stock goes down, covered call is going to expire worthless, most likely, and I'm going to cash flow it, and they're going to pay me. That's it. Every month, boom, 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 boom. So this is a style of investing that I think people need to start thinking a bit more about. Now, let's dive into the current, or let's look at the past, move on ARK. So ARKK right here has moved from, let's go from like May 3rd, or let's call it May 1st. So May 1st, it was down around like 35 bucks. Okay, so from May 1st to June 1st, what did it do? And then it went up to, on June 1st, it hit a higher of about 41.50. It's about a 17% return from May 1st to June 1st, okay? Let's go to OARK to show you guys an example of how this would work. Obviously, we're starting to see there's more and more and more and more volume on these ETFs. They're fairly new. Not many people know about them. And I'm not being paid by anyone to promote these ETFs. I actually legitimately do not care if you buy these ETFs. But I want to expose you to a new way you can start thinking about investing without having to buy 100 shares of a stock to sell covered calls to protect your downside and to cash flow yourself. You can invest in these. Yeah, the expense ratio is about 1%. But you don't have to do anything. That dividend will show up in your account monthly. And then guess what? You can have it set to auto reinvest, buy more shares, boom, 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 compound, compound, compound over the course of however long. This is interesting, especially if you can get exposure to some of the tech stocks out there these days without having to necessarily just buy Apple and then hope Apple goes up, right? And a lot of these tech stocks don't have good dividends. They don't pay dividends. So here's your way to get dividends. Sell covered calls and boom. This is your way to do it. Okay, so same time frame. Let's go back here let's go from May 1st to June 1st on OARK. Where is June 1st? Right here. Did about 10 to 11%. So just shy, I believe, of what we got on ARK, because ARK has been up over the span. So your upside is capped a bit. Obviously, if the stock goes crazy, your upside is definitely going to be capped because of those selling covered calls. But again, in that span of time, what you would have captured, or what you would have been captured was, let's say, the May dividend, which is about 36 cents a share. OARK is 17 bucks. Do the math on how much you could buy, how much that dividend would be for you, and now back your way into, oh, that would be an X% return, or that would be a return of this many dollars. That's pretty cool. This is what I want you to start thinking about. Now, going outside of YieldMax, there's other ones out there. You can start doing some research into this. Of course, this is a whole rabbit hole you can dive deeper into. The next, or one of the other ones I want to pull up, is JEPI. Here's one that I have been watching and following, and I like this one a lot myself. But again, just because I like it doesn't mean you have to like it. This is going to give you more of a total stock market exposure, more kind of like a Dow exposure, and they're going to pay you a nice dividend. JEPI currently pays, as of right now, a 10.91% dividend. That is split up and paid out monthly. It's the same thing. It's an income ETF. They're selling covered calls, essentially selling covered calls, writing covered calls, and this way they can pay you and cash flow you every single month, while also holding and giving you exposure to a large collection of stocks. So the way I like to go about this is either you're going to go about the YieldMax ETFs and start building out and buying individual ones and making like your own little portfolio, or you could go the route of, let's go buy more of a S&P high dividend ETF, or a S&P kind of covered call cash flow ETF, or something along those lines. That would then pay you monthly like a JEPI. There's also nowadays, you can also look over into the bond market, TLTW, for example. Here's TLTW. It's the 20-year Treasury bond buy right strategy ETF. So essentially it's the same thing. You're going to get your TLT exposure. You have exposure to bonds, but they're also going to be selling covered calls, writing covered calls. And this yield is at currently right now 18.37% for a year. So just letting you know, this style of investing, this style of dividend investing is starting to gain traction. It's still fairly new, but I think it actually could be a really cool piece to a portfolio. And I know a lot of people out there now that are just diving deeper and deeper into this and are just chomping at the bit to build a portfolio with a bunch of these different high yield ETFs, getting your exposure. Yeah, sure, cap my upside. I don't care. My downside's kind of protected because I'm getting fat dividend yields. And I'm also getting general exposure to the stocks and to the sectors that I want to via the ETFs, via the stock selection that I'm choosing. There you guys have it. This platform right here that we do our charting on is TradingView. Links to that down below. Want to check out Lux Algo for some awesome indicators. Those will be down below. This is not sponsored by YieldMax. No. I'm not selling you these things. This is a style of investing that I think is starting to build traction and taking the industry by storm. And I think it's worth investigating. Thanks so much. Hope you guys enjoy. Share this video with a friend, and I'll see you in the next one. Peace.